Income Tax 2020. Accounting Methods. Come in, relax with Income Tax 2020. Sole Proprietorship Schedule C Business Accounting Methods. When thinking about a sole proprietorship with regards to our income tax equation, we're going to be on the top line item, the income line item. Remembering, however, that the Schedule C business will be reported on a separate schedule, that being the Schedule C, it having income and expenses, the expenses basically being deductions on the Schedule C, getting us down to basically net income, the bottom line, the taxable income of the Schedule C in essence. That net income on the Schedule C, the net taxable income, rolls into the top line of our income tax equation here. Then we're going to be applying out our above the line and below the line deductions from that point in time. We're going to be considering the accounting methods primarily as they're going to be applied to the Schedule C type of business. Remember, for individual income taxes, we're basically thinking cash method. That's going to be the default method unless the code says otherwise. When we go to the Schedule C, we have the small business, the sole proprietorship business. It could be a little bit more confusing because one, we might have other methods or other options for methods that we can choose. And two, when we think about accounting in general, just accounting concepts and how to record things like generally accepted accounting principles, then that's typically going to be on an accrual method. So then we have a question of what method can we use, what method should we use with regard to the Schedule C type business. Now note, if you're doing tax preparation, then obviously you're going to basically typically get the books that have already been created using whatever method that you're going to be using. You're going to do the data input. You'll probably also be dependent on what has happened in the prior year. So whatever method was being used in the prior year is probably the method you're going to be used in the current year. But you might have questions by people as to what method they should use if they're thinking about opening a business or if it's the first time that you're recording a business into the tax software. That's usually when basically the question comes up. And then the question is, of course, should we be using a cash method, or when can we use the cash method? Should we be using an accrual method? Are we required to use one method or the other? Is there any complication between the method we're going to use for taxes? Is it going to differ from the method we use for standard accounting? Will that complicate things? So these are kind of some of the questions that come up with regards to accounting method for the sole proprietorship. So we're talking about a sole proprietorship. This is the 1040, the sole proprietorship affecting multiple lines on the first page of the 1040. We have the 100,000 here coming from the Schedule C, going to Schedule 1, and then coming here to the first page of the 1040. We have the self-employment tax, which is going to have an impact on Schedule 1 Part 2, flowing through here for half of it being deductible on the first page. We could have the qualified business income deduction. So just remember, the Schedule C can have an impact on many different areas. Here's a look at the Schedule C. We've got the income up top. We've got the expenses down below. There's where that 100,000 came from. And here's where we mark what accounting method we have, right? We have the accounting method, cash, accrual, or some other type of method. So when we think about accounting methods, you can think about them as being basically cash and accrual. But most people think of them being basically completely two different things, or completely different, but it's actually more of a spectrum that we're using more of the time. We're going to be more, you might have an accounting method where you're using some cash concepts for some part of the accounting cycles, and you might be using some accrual concepts for other parts of the accounting cycle. For example, if you look at the tax code itself, even if you're looking at the tax code for a business like a partnership or a corporation, then the tax code is basically made up of something in between an accrual method and a cash method. You're following the tax code's method in terms of what you need to do in terms of recording transactions. So, but these are the two ends of the spectrum you're typically thinking of: cash, full accrual, and then possibly some transactions in the middle being either cash or accrual based, depending on what accounting method you're using. And of course, given this is the tax code, also depending on whether the tax code has some kind of requirements from you to deviate from whatever method you're using for whatever reason. So for example, if you're on a cash method, then the code will still force you to deviate to an accrual method sometimes. For example, when you buy equipment, if you bought equipment like a $10,000 piece of equipment, and you paid cash for it, you'd think you'd be able to just expense it when you paid for it. Now you might be able to, but you'd have to use like an accelerated depreciation method or something like that, because the general rule is that you got to put it on the books as an asset. first. And by doing that, you're deviating from basically a cash method. You're following the code, which is saying, yeah, you got a cash method except in this transaction, which is more of an accrual method. So just remember that there's going to be kind of deviations oftentimes between these two. These two are kind of two poles, and then you could have transactions in the middle that basically deviate from them. Okay, so most of this information is coming from the 2019 tax guide for small business. Notice that the Schedule C for 2020 is out. When we see our examples, we'll be using 2020, but the tax guide is only in 2019 thus far. We'll make changes where applicable, but if you want to go in and do some more research, obviously you could take a look at the IRS website, look up the tax guide for small businesses. The 2020 tax guide hopefully will be out shortly, but we want to push forward with it at this point, and most of the accounting methods should be pretty much the same from 19 to 20. So accounting methods. An accounting method is a set of rules used to determine when and how income and expense are reported. So notice they're focusing in on income and expense. You might be saying, well, why doesn't it focus in on assets, liabilities, and equity? Because income and expense are the timing accounts. So it's about timing. The income and expense that is the income statement, and the income statement is basically the timing account. So we're focused in on those accounts, even though the balance sheet will have accounts that are basically accrual based, meaning accounts receivable, for example, is an accrual account. If you are on a cash basis, you would not be recording accounts receivable. But you have the accounts receivable due to the fact that you're recording income at a specific point in time. You're recording income in that case before you actually receive the cash, resulting in an accounts receivable on the balance sheet as well. So your accounting method includes not only the overall method of accounting you use, but also the accounting treatment you use for many material items. You choose accounting method for your business when you file your first income tax return that includes a Schedule C for the business. So that's going to be the key point then, because we have a consistency principle in general, meaning you can't just be changing the accounting method every year. So that means that when you first set up the Schedule C, when you do the first tax return, you want to make sure to consider which method you want to use at that point in time, because once you choose it, you're more or less locked in. It's going to be difficult to change. You got to go through a process to change the accounting method. So when you first set up the Schedule C, that's when you choose the accounting method and put in the time to think, okay, cash or accrual method or some other method. So after that, if you want to change your accounting method, you generally must get IRS approval. See change in accounting method later. So again, we have that consistency principle. You can't just be changing the accounting method all the time, because due to the fact that it is a timing related activity, you could then alter when you're going to be recording income and expenses if you keep changing the accounting method. So therefore, consistency is necessary. Kinds of methods. Generally, you can use any of the following accounting methods. We have the cash method. We've got the accrual method. We have the special methods of accounting for certain items of income and expenses. And then we have combination method using elements of two or more of the above. So again, notice we have this combination happening here, because you might have some people that are basically running part of their books basically on a cash basis and part on the accrual. And you might say, well, why would the tax code allow that? And notice that they're trying to give leeway to a sole proprietorship to some degree. This is one reason they might do this, because if you're just trying to do your books in a way that's custom to your business and you're a small business, a sole proprietorship, for example, if you have to track accounts receivable, then you might be recording accounts receivable and recording your income, say, on an accrual basis, because you need to track the receivables. But on your payables, you might be doing kind of more of a cash method on the payables, due to the fact that you're kind of paying your bills on a cash method. So you're only using the receivables as like your only accrual component there, and the rest of your books basically might be on a cash method. Why? Because that's what you put together that was easy to do for your particular type of business. You needed to deviate from the cash method in the case of an accounts receivable account to deviate. So just note that, again, if you were just to make an accounting method custom to a small business, it's quite likely, it's possible that you could end up with something that has, kind of an in-between method between cash and accrual, because of just the logistics of how it would be for your business to do the best bookkeeping or the easiest process. So in any case, many sole proprietorships will be picking the cash method if possible, because it's typically going to be easier method to track. So if you're just for example, recording your books directly from the bank statements. For example, if you have something like a QuickBooks or something like that, and you're just using the bank feeds to create your books, then you're pretty much putting your books together on a cash basis method at that point. But if you're deviating from that in order to record, say, accounts receivable on your books, then your income is being recorded basically on an accrual method. So if you look at someone's books and they have accounts like accounts receivable and accounts payable, those are basically accrual accounts. They're doing something on an accrual method. Also note that inventory, as we'll see, is something that can muddy up the system and be more likely that someone's going to basically be required in some cases possibly to use an accrual method. So just be aware that if you're dealing with inventory, then there's going to be more pressure in certain circumstances to be pushing towards an accrual method, because once again, the idea that you have inventory in and of itself is basically an accrual method. Because if you paid for the inventory, if you were on a cash method, you wouldn't put it on the books as an asset, you would put it on the books as an expense, when you paid the cash for it. So the fact that you're tracking inventory as an asset basically means that that's more of an accrual component at that point. And so the IRS might have certain rules related to inventory as to when you have to basically go to an accrual method as opposed to being in a cash method. So the cash method, most individuals and many sole proprietors with no inventory use the cash method because they find it easier to keep cash method records. And that's typically the case. If you have like a small business, let's say it's like gig work or something like that, you have no inventory that's going to be involved. You might be putting your books together simply by having QuickBooks software or some other, whatever software you want to use that has bank feeds possibly, and you're completely dependent on the bank feeds. You're basically using the bank feeds. When you have a deposit, it's income. When it's going to be something going out of your bank account, it's an expense. Well, then you're basically constructing your books on a cash method at that point, and the cash method could be appropriate for a small business, especially one with no inventory. However, if an inventory is necessary to account for your income, you generally must use an accrual method of accounting for sales and purchases. So notice it says for sales and purchases, because if you have inventory, then basically you're basically on an accrual method at least for part of your sales and purchases process. So for that part, you're using an accrual method basically for that part. So unless you are a small business taxpayer defined later in this chapter. For more information, see investors later. So income. Under the cash method, include in your gross income all items of income you actually or constructively received during your tax year. So obviously that means you basically got paid. Now again, you can't, the tendency here in a cash method, the downfall of a cash method, the reason like large companies are not allowed to be on a cash method, or one reason would be that you can manipulate the cash method by manipulating when you're going to be receiving your earnings from your customers and when you're going to be making payments. You could do things like say, I'm going to pay, 5 years worth of expenses today at December 31st. And because the cash went out, even though you're getting 5 years of worth out of it, you would be able to deduct it under a normal cash method, or expense it under a normal cash method. Or you can tell your customers, hey, I'll do the work here, but don't pay me until next year or something like that. I'll have an IOU until next year, and that would adjust the revenue. So basically, if you're constructively received it, then you have to record it. So you can't do things like, I'm not going to open the mail because there's a check in the mail, and I just don't want to cash that check because I don't want to record the income this year. I don't want to record it next year, because basically you've constructively received it at that point in time. So if you receive property or services, you must include their fair market value in income. So note, even if you have a bartering situation, if you're on a cash method, you might say, well, if I traded this thing for that thing, no cash exchanged hands at that point, and therefore since I'm on a cash method, I should not have to record anything. Well, they're saying no, that's basically like cash traded hands. You could think of it as two transactions. They paid you and then you paid them back in terms of a cash method. So bartering does not mean that you no longer have, to record income, even though you're on a cash method, and the trade basically eliminated the cash in the transaction. Constructive receipt. You have constructive receipt of income when an amount is credited to your account or made available to you without restriction. You do not need to have possession of it. So even if you don't have possession of it, if it's constructively received, then you got to record it in income. If you authorize someone to be your agent and receive income for you, you are treated as having received it when your agent received it. So an agent basically is someone that works on your behalf. They're working, under your, your instruction on your behalf for your benefit. So you can't basically say that income goes to the agent and I never got it because my agent had it. Well, the agent, again, is working for the person, and therefore when they get it, you have constructively received it and need to record it in income. So cash method. Expenses. Under the cash method, you generally deduct expenses in the tax year in which you actually pay them. So expenses, we're going to be waiting until, of course, the cash goes out. When the cash actually leaves, that's when you would typically record the expense. This includes business expenses for which you contest liability. However, you may not be able to deduct an expense paid in advance, or you may be required to capitalize certain costs. So in other words, one way to manipulate the expenses, like we said, is to say, if I want more deductions in the current year, I can say, hey, look, I'm going to pay you 5 years in advance for the services that you're going to give me, and then I'll deduct it all today, even though I'm paying 5 years in advance. The IRS is going to be skeptical of those type of advance payments because that seems to be manipulating what, the expenses. You're taking that's a way to take the expense now rather than later. It's a timing difference. So any prepayments, then they're going to basically be skeptical of. So that's explained later under the uniform capitalization rules. Obviously, again, if we buy something like equipment, like if I bought a car for $30,000 cash for the business, then the IRS, they're not going to let you basically just expense the $30,000. They're going to make you capitalize it. Now you still might get the deduction in the first year using special depreciation, 179 deductions, but the idea is that it needs to go on the books as an asset because now you bought a large thing even though you bought it with cash. So therefore there's a deviation for the cash method. So expenses paid in advance, you can deduct an expense you pay in advance only in the year to which it applies. So accrual method. Now the accrual method is kind of the other extreme. This is what businesses will be using. Like if you have a C corporation or a publicly traded business, or generally accepted accounting principles will be on an accrual method. Anytime you look up accounting transactions in general, they're usually talking about an accrual method. It's the standard method typically for accounting. So under an accrual method of accounting, you generally report income in the year earned and deduct or capitalize expenses in the year incurred. The purpose of the accrual method of accounting is to match income and expense in the correct year. So we saw that the problem with the cash method, the benefit of the cash method is it can make certain transactions a lot easier. So like we said, if you just have if it's like a gig work type of job that you're doing, it's a service type of job, people are just, paying you, you're not dealing with any inventory or anything like that. Cash method is really easy to track because you just follow the cash, and that's easy to do. However, it's easy to distort, as we talked about as well. So if you use a cash method and you have things like inventory and you make big purchases and whatnot, then it could be easy to distort the cash method. Also, if you need to track receivables, like you do work before you get paid, and then you have to track the fact that they owe you money, that's often a point where you have to deviate from a cash method because you need to track the receivable in order to do so. So you typically will record the income when you earned it rather than when you receive the cash and record the accounts receivable. If you have accounts payable, you have a similar situation on the payable side, but most small businesses, might be more on a cash method for the payables, maybe, and they might be more on an accrual method when they need to track the receivables. Accrual method income. Under an accrual method, you generally include an amount in your gross income for the tax year in which all events that fix your right to receive the income have occurred, and you can determine the amount with reasonable accuracy. So that basically means that you earned it, right? You did the work, you earned the income. From an accounting cycle standpoint, that's usually when you send the invoice out. So if you did bookkeeping work, for example, you sent the invoice out, that's usually where you would record the income under an accrual method, and that's why in like accounting software such as QuickBooks, when you record the invoice, that's when the income is recorded at that point. For a taxpayer with an applicable financial statement or other financial statement, as the Secretary may specify, the all events test for an item of gross income is considered met no later than when taken into account in an applicable financial statement or such other financial statement. Accrual method expenses. Under an accrual method of accounting, you generally deduct or capitalize a business expense when both the following apply. The all events test has been met. The test has been met when all events have occurred that fix the fact of liability and the liability can be determined with reasonable accuracy. So again, expenses in general, you're going to record the expense when the expense has basically been incurred, not necessarily when it has been paid. So basically, if someone did services for you and whatnot, and the agreement had been made, the services have been done, then that's when you should be recording the expense, even though you have not yet paid them. And that's why when you record this stuff into something like a software, like a QuickBooks, when you enter the bill, that's going to increase accounts payable and record the expense at that point in time. So you could also like be on a cash method and just basically record like when you incur the expense, you might just pay it with a check at that point in time. Now that doesn't mean you're deviating from an accrual method necessarily. It just means that you're paying at the same point in time that the work was done. But if the work was done and you're not going to pay them till later, that's when you got a difference between those two time periods. And on an accrual method, you would be recording the expense in the point in time that the work was done, not the point in time when the payment took place. So economic performance has occurred. So that's going to be condition number 2. Economic performance has occurred. The work then has been done. Now again, many small businesses might be more on a cash basis method just in terms of the way they record something for expenses, because they might be paying their expenses basically as they come up, which means technically you can be on either method then. You could be on a cash method or an accrual method. It just so happens that those two things are happening at the same point in time. You're paying the expenses as they come up. So you don't have an accounts payable that you're tracking really, because you're paying the expenses as they come up. And if that's the case, then again, you could be on a cash method or an accrual method, but you're basically, you're recording the income or the expense at that point at the same point in time because the work was done at the same point in time that you paid them. So on a cash method, you would be recording it because you paid them. On an accrual method, you would be recording it because the work was done, but the same transaction would happen at the same point in time.